Investing always involves some risk. It's an inherent part of the process. It's about the possibility of losing some or all of your money. This can be daunting for many. Understanding your risk tolerance is crucial for successful investing. It helps you navigate the ups and downs. Risk tolerance is how much risk you're comfortable taking with your investments. It's a personal measure. It's like choosing a roller coaster ride. Some rides are wild and thrilling, while others are smooth and steady. Some people love the thrill of a steep drop, the adrenaline rush and excitement, while others prefer a gentle ride, enjoying the scenery and the calm. Knowing your risk tolerance helps you make better investment choices. It ensures you don't take on more risk than you can handle. It guides you towards investments that align with your comfort level. This alignment is key to long-term success. This understanding helps you sleep at night, even when markets are volatile. Peace of mind is invaluable in investing. Investors generally fall into three categories: low, medium, and high risk tolerance. Each category reflects a different approach to handling the ups and downs of the market. Low risk tolerance investors prefer stability and security. They often prioritize preserving their capital over making high returns. They choose investments with low potential for losses, even if it means lower returns. This might include government bonds or high-quality corporate bonds. Medium risk tolerance investors seek a balance between risk and return. They are willing to take on some risk for the potential of moderate returns. They're comfortable with some fluctuations in their portfolio, understanding that short-term volatility can lead to long-term gains. High-risk tolerance investors aim for high returns. They are often more aggressive in their investment strategies. They accept higher volatility and the possibility of short-term losses, believing that these risks can lead to substantial rewards over time. Remember, there is no right risk tolerance. Each investor's risk tolerance is unique and should be respected. It's personal and depends on your financial situation, goals, and personality. Understanding your own risk tolerance can help you make better investment decisions. Asset allocation is how you divide your money among different asset classes. These include stocks, bonds, and cash. Stocks represent ownership in companies and offer potential for high growth, but also carry higher risk. Bonds are like loans to governments or companies, offering more stability but lower potential returns. Cash is the safest asset, but its growth potential is limited. Asset allocation is like building a house. Each asset class is a different material, and the right mix provides stability and growth. Section 4. Matching risk tolerance with asset allocation. Your risk tolerance should guide your asset allocation. Understanding your comfort level with risk is crucial in making informed investment decisions. If you have a low risk tolerance, you might allocate a larger portion of your portfolio to bonds and cash. These investments are generally safer and provide more predictable returns. This provides stability and protects your principal. It ensures that your investments are less likely to lose value during market downturns. A medium risk tolerance might lead you to a more balanced allocation between stocks, bonds, and cash. This approach offers a mix of growth potential and stability. If you have a high risk tolerance, you might allocate a larger portion to stocks, aiming for higher potential returns. Stocks can be volatile, but they also offer the possibility of significant growth. Remember, asset allocation is not a one-time decision. It should evolve as your financial goals and life circumstances change. It's important to review and adjust it as your circumstances change. Regularly revisiting your asset allocation ensures it remains aligned with your risk tolerance and investment objectives. Section 5. The importance of diversification. Diversification means spreading your investments across different asset classes, industries, and geographical regions. It's like not putting all your eggs in one basket. Diversification helps reduce risk. If one investment performs poorly, others can cushion the impact. It's a crucial strategy for investors of all risk tolerances. By diversifying your portfolio, you can potentially maximize returns while minimizing potential losses. Remember, diversification is key to building a resilient investment portfolio. Section 6. Take control of your financial future. Understanding your risk tolerance and asset allocation are essential steps in your investing journey. By aligning your investments with your risk appetite and diversifying your portfolio, you can take control of your financial future. Remember, investing is a marathon, not a sprint. It's about making informed decisions that align with your long-term goals. Start by assessing your risk tolerance and consider seeking advice from a financial advisor to create a personalized investment plan. If you found this video helpful, make sure to subscribe to our channel and hit the notification bell to stay updated with our latest content. Take control of your financial future today.